Hey guys, welcome back to the channel. In this video, I'm going to be speaking about some hard truths that you guys need to hear if you want to be profitable traders. So for those of you who don't know me, my name is Gio. I've been a multi-asset trader for over 10 years now, and I've helped hundreds of traders to get funded, become better traders, become more consistent, and hit their financial goals through trading. So let's dive right in. So for this video, I'm going to assume that you already have a strategy. If you don't have a profitable strategy that has an edge in the market, you need to start there. You need to find a strategy that you are able to execute consistently in the market, because I'm not going to be teaching you a system in this video. We're specifically going to be speaking about the habits and the rituals and the mindset that you need to adopt to be able to execute on a trading strategy consistently, which will lead to profitability. Okay, so the first habit that you need to adopt to become a more consistent trader is the ability to detach from your profit and loss. If every time you're in a trade, you're constantly obsessing over your P&L, looking at how much profit or loss you're in, and, it's triggering all these emotions in you, and you're on this emotional roller coaster every time you're in a trade, then you are destined to fail, and you're not going to really find true consistency in your trading until you overcome this hurdle, until you overcome this mental barrier that is blocking you, which is this emotional roller coaster every time you're in a trade. Really, how you want to view your P&L on your trading account, whether that's, personal funds or your funded account, how you want to view it is almost like monopoly money. Now, I'll caveat that later on, we'll expand on that point, but you need to detach from the P&L and, monopoly money or GTA money, you don't see it as real money. If you're playing GTA, you'll go and buy a $1 million car and feel no type of way, right? It's not real money. And in order for you to execute on your trading plan correctly, the money can't be part of it, because when you backtest a system, there's no emotion towards your P&L. And most of you, when you backtest, you are profitable, but it's only when you execute in the live market that now you're unprofitable. The system hasn't changed. The only thing that has changed is the variable, which is you, you, the human, executing on that system. And most of the time, the reason why something changes is because now there's money on the line. You're attached to your P&L. You're attached to that money in your trading account, the potential profit that you could make on the funded account, or the thought of going into some drawdown on your funded account, maybe that scares you. So you're so attached to the P&L that every time you're in a trade, you're not able to think with clarity. That's one of the main reasons why you're not going to be able to find consistency. Now, I need to caveat this because my views about 3 years ago changed slightly on this topic. And the topic is trading your P&L from a macro point of view. So on the micro level, trade to trade, I don't think you should be trading your P&L. But my view changed after a conversation that I had with Brent Donnelly. For those of you who know him, one of the arguably greatest traders of our times, the author of Alpha Trader. I had a conversation with him, which is on this channel, which you can go and watch. And he spoke about hitting the gas once you're in some profit. So for me, I was always very rigid with trading the P&L. And what Brent was speaking about is trading your P&L from more of a macro point of view is okay. And what he meant by that is, if you're in some profit and you find one of those A+ setups, you can afford to hit the gas a bit more and take a little bit more risk on those setups once you've got some profit, which I now agree with. If you're in 10, 20, 30,000 profit and you see an A+ setup, you can hit the gas a little bit more and maybe take a bit more risk on that setup. And, if you're in drawdown and, for example, if you're close to blowing your funded account, maybe you can reduce risk a little bit until you kind of build up a bit more of a buffer. So that I agree with. But on the micro level, this is one of the biggest things that ruins traders is every single trade, monitoring it like your life depends on it. Like if this trade doesn't hit take profit, then you're not going to be able to pay your rent. You're not going to be able to put food on the table this week. And that is one of the biggest killers for aspiring traders, being completely attached to the money and completely attached to the P&L. Now, again, another caveat of this is if you've got a 200K funded account, you're in 20K profit, and that's the most amount of money that you've seen in your life, 100%, you should withdraw that, reinvest in your education, reinvest in more funded accounts, and that will allow you to scale, okay? But on the micro level, specifically trade to trade, you should not be attached to the money at all. That is going to completely ruin your trading. So the second one is not every day is a trading day. Now, for new traders especially, this sounds very, counterintuitive. The mindset of a new trader is, well, if I take more trades, I'm going to make more money. However, the opposite is actually true. The less trades that you take, generally the better quality trades that you'll be taking, because there's not always going to be an opportunity in the market, regardless of your strategy, whether it's a scalping strategy, a swing strategy. There is no one strategy that every second of every day, or every single trading day presents an opportunity. So you need to adopt this mindset that your goal is not to trade every day, constantly be in the market. Your goal is just to execute on your plan. And the sooner you can adopt this mindset and completely detach yourself from the money, from the market, and just come to your trading desk every day with the mindset that your only job, your only goal is to execute on your trading plan, that's where the winning happens. That is one of the holy grails of trading, when you completely detach from any emotion, from any P&L, and you just submit to your trading plan, to your strategy, and almost execute on it like a robot. Now, there's some variables that can change, and we won't get too deep in this video, on that topic. But the main point I want you to take away from this section is that not every single day is a trading day, and that's fine. There are three main pillars that you can build a system around. One is profit, one is risk management, and the third one is trade frequency. Now, generally speaking, you can only have two of the three. Now, any trader would look at that and say, okay, well, the first two, profits and risk management are definitely the key. But a lot of new traders and people that constantly want to be in the market and still have that gambler's mentality, they try and optimize the first two, but also trade frequency. And that doesn't work, because if you're taking trades that don't meet your plan just to be in trades to optimize for frequency, well, then one of them is going to get sacrificed, right? Either profit or risk management. And most of the time it's risk management, which directly affects your profit in the end. So the main point I want you to take away from this is not every day is a trading day, and that's absolutely fine. I know it feels counterintuitive, but it's absolutely normal. And, it's part of the game we play. And, once you adopt a probabilistic mindset, you're able to accept that truth. If you think about your trades, you want to be almost like a trained sniper, just waiting for the right moment to shoot, not just this machine gun mentality where you're, spraying and praying. You want that sniper mentality where you're waiting for the exact moment to pull the trigger. And sometimes there might be days where you don't take a shot, and that's fine, because you don't want to waste bullets. You don't want to, give up your position. If you're a sniper, you want to wait for that right moment. And that's almost the mentality that, you need to adopt when you're trading and when you're executing on your trading plan. Okay, now the third point almost follows on from what we were just speaking about, but it's about sticking to the plan. And the main topic within this section that I want to focus on is periods of drawdown. Most of the time when a trader doesn't stick to the plan, it's because they're in a period of drawdown. So they feel they need to deviate from the plan. Now, on the screen, I'm going to try and throw up some screenshots which show you the stats throughout Michael Jordan's career and Kobe Bryant's career. Every three-pointer that they took, how many of them they ended up scoring. Now, you'll see for both Michael Jordan and Kobe, it's only about a third of the shots that they took that actually ended up going in the basket and they ended up scoring. Now, you need to imagine, basketball is very similar to trading in the sense that the distribution of those shots, or the distribution of trades, is random, right? You can take 100 trades and 50 of them could win, 50 of them could lose. That doesn't mean that for every one you took, the next one's going to lose. It means you could have 5 winners in a row. You could then have 5 losers in a row, right? The distribution is random. And it's the same for them. Every time they shoot a three-pointer, they might have hit, 3, 4, 5 in a row. They also might have missed 3, 4, 5 in a row. So the distribution is random. But what I want you to imagine is, imagine Michael Jordan missed 5, 6, 7 in a row and then just stopped shooting. He wouldn't have done that. That would have never happened. He had to keep shooting regardless of the distribution. He had to stick to the plan, believe in himself, back himself. In our case as traders, it's about sticking to our plan, backing our plan, and not deviating from it, even when there are periods of drawdown. Because look, every single trading system has periods of drawdown. There is no one system that is perfectly optimized for every single type of market condition, right? There's always eventually going to be periods of drawdown where the market doesn't favor your system. If you're a swing trader, for example, a tight range is your worst nightmare. If you're, scalping, then, really volatile markets where we're constantly taking out different highs and different lows and the structure's changing, it's a very indecisive market, well, then that's probably not going to be great for you, depending on your system. But you guys get the idea. There's not one system that is perfect in all market conditions. So just because you have those periods of drawdown, the last thing you should be doing is deviating from your plan. You need to stick to the plan, like Kobe, like Jordan. You just keep shooting, you keep the faith in your plan, and you just keep on executing. And again, that's where the true consistency is the ability to weather that storm. We spoke about this in the New York log briefly for those of you who watched it. That mental barrier where you have those big losing days or you have those periods of drawdown, if you can get over them, that's where the winning happens. That's the holy grail is the consistency, to be able to consistently execute on the plan. Now, going back to what I spoke about earlier, you need a trading plan, you need a system, you need a strategy to be able to execute on this for this to work, right? You don't just want blind faith in flipping a coin, long or short. You need a system. But once you've got that system, you then need the faith in it. You need to, build that conviction in the system, through different methods like backtesting and collecting the data, so that when you're live testing, when you're live trading, if you do have those periods of drawdown, if you miss, 5 3-pointers in a row, if you lose 5 trades in a row, you're able to continue executing on the plan. And there's a few things that help with this. If you're disciplined in your personal life, generally speaking, it's a lot easier for you to execute on your trading plan and be disciplined with your trading plan. Also, just reminding yourself at the beginning of the day, what you want out of today in terms of your trading, or what kind of trade you want to take. If you write a little journal of, I'm going to wait for X, and when X happens, I'm going to do Y. Just reminding yourself at the beginning of the day what your kind of like A+ setup looks like, or what your trading plan is. That's also really going to help you execute on your plan. But ultimately, it comes down to your mental fortitude and, your discipline in being able to execute on the plan. Okay, now the fourth one is around risk management. Now, this term gets thrown around in the trading niche. A lot of people don't know what it means, especially beginning traders. But, risk management is one of the keys to profitable, consistent trading, because this is a game of survival. So every time you're about to take a trade, or you're, planning a trade, you should be starting with the risk. Don't start with the potential reward. Start with, where is my invalidation? Where am I going to place my stop loss? How much could I potentially lose on this trade? How much am I willing to risk on this trade? And really what you need is a risk management plan. Okay. And this can be different for everyone. The standard one that gets thrown around is, 1% risk per trade. But, depending on the system, depending on the account that you're trading, it can vary. So you need to come up with a plan that makes sense for the account that you're trading, the goals of the account, also the strategy that you're trading as well. If you're taking 5 trades a day compared to a swing system, which is maybe 2 trades a week, well, then the risk per trade should be very different. Okay, so first step is coming up with a risk management plan. I'm going to assume that you have one already as part of your trading system, which you should already have as well. But the key around risk management is not how much you make, it's how much you keep. You want to focus on capital preservation before you focus on capital appreciation. So again, going back to focusing on the risk of every trade, what is the most we can lose, making sure that our stop loss is placed correctly, so that, if you go into some drawdown, you don't feel like moving your stop loss because you've already accepted the risk. And this is a key point within your risk management plan, is the risk per trade, or the risk per setup, depending on, the quality of the setup, should be an amount that you are able to accept. And what I mean by that is, if you're going to risk 1K on a trade, you need to fully accept that risk and almost go into it with the mindset that you're willing or happy to lose 1K on this trade, given the probability or the risk to reward, or, the likelihood that you think this trade's going to play out. You're happy to risk X amount, let's say 1K, like I said. If in your risk management plan, you've got a risk of say 3K per trade, say you're trading a $300,000 account, 1%, 3K, but then every time you enter a trade, you start deviating from your plan because, losing 3K on a trade is too much for you to handle. Well, then you need to move in smaller steps. You need to be willing to risk an amount that you're willing to lose so that you can fully accept the risk, so that you're not then caused to deviate from your plan, or so that once you're in the trade, because you've already accepted the risk, you've already accepted, okay, if I lose, I'm going to lose, 1K, 2K, 3K, whatever it is. So you need to factor that in as part of your risk management plan, is almost work with yourself. Don't make your job harder as the risk manager by, trading amounts that you don't feel comfortable with, or you're not quite there in your journey yet to be able to handle those P&L swings. Now, one thing that's going to massively help with this is, once you're in a trade, don't look at the P&L, look at the chart, especially if you're trading a pure technical system. Don't look at your profits and loss. In the back of your head, you'll roughly know what it is, but the only thing you should be looking at, especially with a pure technical system, is the chart and, the management of the trade. You should not really be looking at the P&L. It's not going to benefit you in any way, shape or form. And then just before we sign off this section as well, never move your stop loss. Like I say, this is one of the most important parts of any trade or any specific trade idea, is having a level where you accept you're wrong, having an invalidation level. That's where your stop loss should be. And, if it gets hit, then you should get out of the trade. You should not be holding on to these losing trades that have gone past your invalidation level. I know it's hard sometimes to accept the risk and, close that risk, but it's what you need to do because you need to avoid those big losses. So the fifth point is strategy hopping. And I know this has probably ruffled some feathers. Everybody is guilty of this, but this is one of the biggest killers that I see, beginner traders make, even aspiring traders that maybe have, 1, 2, 3 years worth of experience, is constantly hopping strategy. And what this does is it doesn't give one strategy enough time to truly play out. Because like I said earlier, every strategy has a period of drawdown. Every strategy, it's inevitable. You're going to have 2, 3, 4, 5, 6 losses in a row at some point within the system. What most traders do at that point is they deviate and they say, okay, this strategy doesn't work. I need to find another strategy. And I know it's really hard because on social media, it looks like everybody's always winning and the strategy that that person is trading or teaching doesn't lose, right? Every single trade seems to be a winner. Every month they're making profit. Every week they're making profit. Every day they're making profit. But the reality is not that. Every system has losing days. Every system has periods of drawdown. That could be a day, a week, a month. It could even be a quarter. It could even be longer. And that's just part of the game. This is a game of probabilities. And the distribution of trades is random. You can have a system that on average does 4% a month, 5% a month. That doesn't mean that you're not going to have a month where it loses. It's an average. It also means there's going to be months where you outperform as well. You might do 10% in a month, right? But like I say, the distribution is random. Like the basketball analogy earlier, the worst thing you can do when you go into a period of drawdown is start deviating. And, every time you're in a period of drawdown, you then move to a different strategy. You're never going to win that way. You're never going to give one system enough time to truly show you the edge that it has in the market. Another topic around strategy hopping is trying to mix too many different strategies. So if you think of this as food, you might like steak, you might like fish, you might like ice cream, fruit, pizza, right? We like all of those foods individually. If we mix all of them together and we have an ice cream pizza with fruit and steak and egg and fish on it, well, then it's not going to taste very nice. So think about trading systems like this. If you try and mix 2, 3, 4 different trading strategies into one, and you think, well, I'm just taking the best parts of all of them, more often than not, it's not going to work. Okay? Just like all the foods won't taste great altogether, but individually, they do work. So I'm not saying it can't work mixing strategies, but generally speaking, if you try and outsmart the market and try and combine too many different things, you're going to overcomplicate it, and most of the time it's not going to work. What you want to do is, find a mentor, find a system, and trust that system, trust that mentor, and execute on that. And then once you've mastered it, you can then build on it. You can then try and add ingredients slowly, but don't try and add all these different indicators and EMAs and smart money concepts and all these different things all at once. You want to slowly introduce things, back test it, see if it works, see the difference that it makes, and do that one by one rather than all at once. Okay, now the next point is about treating trading like a job or a business and not approaching it from the mindset of a gambler. Now, I want you guys to adopt the mindset that you work at JP Morgan or Citi, and every single trade you take, you have to go and explain to your senior or to the board, to the powers that be, why you're taking this trade. And if you can't justify or convince them hypothetically why this is a good trade, then you probably should not be taking the trade. Like we spoke about earlier, if you're getting into the market just for these dopamine hits, you're just gambling. Okay, you need to stick to the plan. You need to have full justification and reasons within your plan as to why you should be taking this trade, not just because of vibes. If you winged everything at work, would you be taken seriously? Of course not. You need to apply that same mindset to trading. You're not winging things. You're sticking to a plan. You're executing on the edge, and everything you do is calculated. You've got a reason as to why you're taking these trades, as to why you're risking the amount that you're risking. There's full justification. Not, if somebody asks you why you're taking that trade, you just say, just because I thought it was going to go down, or why are you risking that much? Oh, just because I want some money for my holiday, or, whatever it may be. You need to approach this from a professional standpoint. And until you adopt that professional mindset and that professional approach, you're never going to have consistency. You might have a month or two where you win, but if you just go back to being a gambler straight after that, then you're never going to have that consistency long term. So you need to have that professionalism towards trading. Remember that gamblers want excitement, traders want results. So you need to completely remove emotion, you need to create systems, and then you need to track the metrics of the system. Okay, that is the professionalism that you need in terms of practicality. Then you need the mindset of a professional as well. Now, this next one is one of the most important ones. And if you've made it this far in the video, then congratulations, because this is one of the main killers that I see for aspiring traders. And this is about funding and putting funding on a pedestal. So many traders just think, when I've got that 100K funded account, when I've got that 200K funded account, I can quit my job. You know, all I need to do is make 3% a month on this funded account, and it's going to completely change my life. I'm going to make, 3, 5, 6K a month. If you put funding on a pedestal like that and you think of funding as the one thing that is going to get you out of the situation, or the one goal that you have is just to get funding, as soon as you get the funded account, you might get one payout if you're lucky, then you're going to blow it. I promise you, if you put funding on a pedestal, it is one of the worst things that you can do. What you need to see funding as is a stepping stone. Okay, it's just one of the stepping stones that's going to get you to ultimately where you want to be. But that 100K, 200K funded account, you cannot put it on a pedestal. You cannot see that as the summit or see that as the holy grail, because in trading there's no summit. Unfortunately, it's a constant climb, it's a constant battle, it's a constant war, with the market, with yourself. There's no summit. And what this leads to is, most people, once they've got the funded account, they change how they trade, or they start trading their P&L, like we spoke about earlier on in the video. They start deviating from your plan, which we've spoken about. They deviate from their risk management plan. They've created so much emotions around this funded account that once it happens, it's like this emotional release, and that then affects their trading. So please, please, please do not put funding on a pedestal. Please don't put that one funded account on a pedestal and think, oh my God, my life is going to change. I can quit my job, once I've got this one funded account. Unfortunately, it doesn't work like that. And you're creating so much emotion around this when, what we want to be doing is detaching emotion from any of this. Because once we detach emotion, that's going to allow us to think objectively and trade better, trade and execute on our plan much easier, because there's no emotion involved. We're not trading the P&L. This mindset of putting funding on a pedestal, it creates more pressure, not more freedom. Okay. If you see it as a stepping stone, it can create freedom. If you see it as the end goal, if you see it as, the holy grail, the one thing, the summit, at the top of the mountain, then it's going to put too much pressure on you. And like I say, it's going to create too much emotion around it. Remember, funded or not, the game is exactly the same. You want to survive, then you want to grow, and then you want to compound. So you can have multiple funded accounts. So you can trade your personal account. So you can diversify, outside of markets into real world businesses, whatever that may be, property, or, whatever your financial goals are, whatever you want to diversify into. Last but not least, we have letting go of your ego and becoming a trader and not just an analyst. Now, I've spoken about this before, but do you want to be right, or do you want to make money? Analysts want to be right. Traders want to make money. I know some great analysts that are, great at technical analysis. They're great at creating trade ideas, but they're not good traders because they don't have all of the qualities that we've spoken about in this video to be able to stick to the plan, to be able to detach from the money. They're great at TA. Like I say, they can tell you where Euro USD is going this session, but they can't make money with that information because they're not good traders. Now, I need you to adopt this mindset that an analyst and a trader are two completely different things. And you need to decide, which one do you want to be? Do you want to be an analyst, or do you want to be a trader? Do you want to be right, or do you want to make money? If you want to be a trader and you want to make money, then you need to completely emotionally detach, and you need to not focus on being right. You need to not stay in a trade in the hope that it reverses so that you end up being proven right. You need to just focus on executing on your plan and making money in the market. Because so many people think that technical analysis equals profitability, and that's not the case. It's execution, psychology, risk management. They are ultimately the three pillars that make up real trading. That's what makes a trader: being able to execute, being able to manage risk, being able to manage their psychology. And, that comes with being consistent in the execution of the trading plan. That is the holy grail that you're searching for. Again, look, I'm assuming that you've got a profitable strategy already. That is one of the keys here, is that you have a profitable strategy. Most of the time, it's the trader sabotaging the strategy rather than the other way around. Again, look, there are a lot of terrible strategies out there. I'm not saying that every strategy has an edge, but for the purpose of this video, we're assuming that you have a strategy that has an edge in the market, but you are sabotaging it. So just remember, you are a trader, not an analyst. You don't want to be right, you want to make money. They are two completely different things. The sooner you adopt the trader mindset, the sooner you're going to find consistency, the sooner you're going to find profitability. Remember, trading isn't a hack. It's not a shortcut. It's a craft. It's a craft that you need to master. It's more about you against yourself rather than you against the market. And if you're willing to approach it with humility, discipline, and patience, then you'll survive long enough to thrive. But it's if you come into it with this get rich quick mindset, this Wi-Fi money mindset, that you're probably not going to make it that long. Okay, guys, so they are the 8 habits of a consistent, profitable, and winning trader. I hope you got a ton of value from this video. We're going to wrap up here. Make sure you like, comment, and subscribe, and I'll see you in the next one. Take care.